Let's cover some basic concepts about the 200. The 200 period moving average is the granddaddy of all moving averages. It is the most powerful moving average of all. As we know, if a stock is above the 200 and drops to the 200 will tend to be at least temporary support. So there will tend to be some halt and rebound of some sort, and that is what you see here. So we start from above the 200, we come down to the 200, and there is some reaction off of the 200. The 200 will tend to have some level of support if you're coming from above it. Oftentimes, when you're coming from beneath it, it will tend to have some resistance and some reaction, although it didn't do that very much here. A little bit, but not much. The flatter the 200, the more powerful. You can tell kind of over on the left, the 200 was sort of rising, but it got flat here. The flat 200 period moving average, for whatever reason, is more powerful as a support and resistance item than a slightly rising or slightly declining. But keep in mind that the 200 is always powerful. I'm just talking about the flat 200 is its most powerful. I want you to also understand that the chart would have you believe that the 200 is very thin like that, but in reality, the 200 is more like a zone. It's a support and resistance zone. So look at it more like a fence you can lean on, or a trampoline you can bounce on, or better yet, boxing ropes you can lean against. So this is not really a break of the 200 per se. It's a lean against the ropes, and the ropes swing the stock back. So we press up against the ropes and get thrown back a bit. Guys, in order to get a flat 200, you must kind of have equal life above the 200 and equal price life below. Does that make sense? That's how you get a flat 200. They're like 50% of the stock's life in recent history was above the 200 and 50% of its life is below the 200. Yes? Okay, that's how you get a flat moving average, right? So your stock is basically neutral from a 200 perspective. So it's important to understand that in order, remember, a moving average is averaging out the price activity. So if a moving average goes like that, that means 50% more or less has been above the 200 and 50% of the stock's life in recent history has been below. But that's based on the 200. Now here's something interesting. So we've got this flat 200 here, which means that from the 200's perspective, the stock is flat, all right? But from the 20 perspective, a shorter time frame, it's not flat here. And that's what we're going to really talk about today. We've covered the 200 being flat, being at its strongest, but also that it is not just a skinny line. It is a zone, if you will. So don't get confused and think that this is a true break of the 200. It's just a press up against the zone of the 200. This is not a break of the 200. It's just a press up against the zone of the 200. The 20-period moving average is, in my opinion, the most important short-term moving average. Now, the 200 is a long-term moving average. The 20 is the short-term moving average. And whenever you're using a dual moving average system, you should be using a long and a short together, not a short and a short together. But the two staples should be long and short, and that's what we have. So the 20 is our short-term moving average. And the thing about the 20 is that it too is a zone. So don't think of little tiny breaks like this as breaks. This is just leaning up against the zone of the 20, right? It's not really breaking. It's leaning up against the ropes. The ropes bend. Ropes have leeway, and you can lean on the ropes without truly breaking them. So keep that in mind. And also keep in mind that the 20 has support and resistance qualities as well. So when you are under a 20-period moving average and you move up to a 20-period moving average, there is a decent likelihood that there is some reaction off of it. If you are above the 20 and you drop to the 20 period moving average, there is a decent probability that the stock has some reaction off of the 20 period moving average. This sets up some really wonderful trading opportunities. The other thing I want to mention about the 20 is that while the 200 is the most powerful when it is flat, the 20 is most powerful when it is rising or declining. So the 20 period moving average is the most powerful here on the upside, and that is when its supportive qualities are at its best. When the 20 is declining, it is also powerful, and that is when its resistance qualities are at its best. So the 200's support and resistance qualities are at its best when it's flat, and the 20 period moving averages support and resistance qualities are at their best when it's trending up or down. This is what sets up sound market play, traders. If you can ensure that most of your entries, long or short, or are at or near, that's important, not at all the time, but near, at or near one of these two moving averages, you will radically improve your trading. This is very general. Just every time you enter, almost every time you enter a stock, almost every time, let's say 80% of the time, if your every entry is near either the 20 or the 200, if you can do that, you can ensure that the vast majority are that way, you will radically improve your trading. That's number one. Number two, if you're playing near the 20, if you can ensure that not only that you're entering at or near the 20, but you're entering at or near the 20 in the direction of the trending 20, you're going to double your accuracy rate. The 20 is like a river. When it is trending hard, it's like a strong current downstream or something. And if you just dive into that current, the current is usually so powerful, it'll just take you away with it. You can even enter wrong right there. That's wrong because you're entering too far away from the 20. And it still works because the current is so powerful. These basic things based on these two moving averages, making sure that most of your entries are at or near one of these moving averages, making sure that if you're playing near the 20, that you're playing with the trend of the 20 and not against it, unless you're far, and that's a different topic. This is far, which means the 20 is no longer relevant. It's too far away. It's not far. We want to play with the 20. Now let's get to the main concept today. I want to talk to you about the 20 MA squeeze. I told you that when the 200 period moving average is flat, it is at its most powerful. There is an exception when it actually will get run over in most cases by a freight train, and it's when the 200 is flat and the 20 is rising under the 200, narrowing the space, so wide, less wide, less wide, less wide, less wide, less wide, right? So the 200 is flat, the 20 is rising, and the price is trapped between both, a ping pong ball. If the 20, here's the key, if the 20 is containing the price activity, meaning it won't let the stock break, it's saying, nope, you got to stay within my control. If the 20 is controlling the price, it's going to throw the price above the 200. It's going to overpower the 200. So it's almost as if the 20 and the stock have joined forces together to overrun the 200. And the reason why this is important is because I need you to understand that a flat 200 is very powerful, but I need you to understand when its exception to the rule is when the 20 is rising back toward that 200 and it's controlling the price, 20 wins. not the 200. The 200 is going to get overrun most of the time. Why is this important? Because if you've got this scenario, let's say, for instance, traders, this is one of your cards, a bull 180. Boom. So we have a bull 180 scenario right there. Boom. I mean, right up to 20. But you say, well, Oliver, why would I take that? Well, the 20's rising. Yeah, but Oliver, I'm under the 200. Why would I take that? I'm in the trap zone. No, why would I take that? Because you've got this scenario. You've got the exception scenario. You've got the flat 200 above, but you've got the rising 20-period moving average that's giving you a buy signal, and it's containing the price activity. And so the 20 and the price are ganging up together to overrun the 200. So in this case, you wouldn't be afraid that there's resistance above, not in the 20-period moving average squeeze. Let's take a look at the 20-period moving average squeeze in reverse. Drop, boom. The 20 contains the rally, just like the 20 contained the drop. It throws the stock back down. Boom. I would dive right into that bear elephant bar. That's one of your cards, bear elephant bar. But Oliver, the 200's there. Aren't you afraid that it's going to be support? No, because the 20 is squeezing the stock between the 200 and the 20. The stock and the 20 are ganging up together to crash through the 200. Doreena's asking, isn't this the same as the 20 MA halt? Well, no, it's not, because what if the 200's not there? That's a 20 MA halt. But with the 200 there, it's something more. It's the 20 MA squeeze. You could have a 20 MA halt with the 200 up here somewhere. And that's just a plain 20 MA halt, right? And the 200 has nothing to do with that. But in this case, you got the 200 close. And so a lot of traders miss opportunities because the 200 stops them. But I don't want it to stop you in this squeeze scenario. Guys, there are times when this price will get squeezed so tight like that, then it takes off.
What I want to do here today, a dive into your most powerful event of all. Not only is the most powerful, but it statistically delivers some of the biggest gains. So you have a list of events that you should be largely relying on to take your action. Out of the list of events that you have a card for each one of the events. But out of all of those events, there is one that is the mightiest in terms of power and profitability. And that is the 180, the bull and bear 180. Now, I want to do a dive on this because I'd like all of you to become bull and bear 180 experts, not only in terms of playing them, but of course, before you play them, you have to become good at identifying them. There are two ways to enter. You have to understand each of those two ways to enter. You also have to understand what position and location makes this very powerful play even more powerful. I teach predominantly from the bull side, and I like to show examples from the sell side, but we'll look at both sides here. We're going to take the bull 180 first. The 180 is made up of two bars, but they're unique bars. In truth, a pure unadulterated bull 180 is made up of two elephant bars. One of those elephant bars, or the first elephant bar, is red. It is a down bar, and it is followed by immediately an even more powerful green elephant bar. The first thing I want you to understand that the bull 180 in its true pure form is back-to-back elephant bars, with the green one being taller than the red one. Powerful elephant bars have a very high follow-through rate. A solid elephant bar like this, it's close to an 80% follow-through rate. 8 times out of every 10, you get another red. You get more red that follows. That's what I mean by a follow-through rate, that you get more of that color later. But here with this elephant bar, that 80% gets nullified. I'm going to share something with you. This should follow through 80% of the time. When it doesn't, when a solid elephant bar doesn't, and it gets neutralized as it does in the bull 180, it's typically bigger on the upside than it would have been on the downside. These are just a few of the reasons why the 180 is so powerful. It is overcoming clear, unadulterated power from the opposite side, showing that it is so powerful. It is more powerful than the powerful. So the green power is more powerful than the powerful. It is so powerful that it is reversing something that has an 80% follow-through rate. All this means is that green is the dominant force, and the move to the upside is usually bigger than normal. So if we could normalize every move to the upside from an event, the moves to the upside from a bull 180 will statistically outpace the moves from other things. It happens to us about 15% of your plays will tend to be bull and bear 180s. The bull 180 is generally a confirmation entry event, which means that you buy the moment the instant green takes out the high of the red. Boom, there's your entry. You do not wait for this bar to finish trading. You buy into the bar as it's still a live bar. And as soon as it crosses the high of the red bar, you're golden. There's always a little bit of confusion as to whether or not you wait for a tail. Let's say there's a little tail up here on the red bar. Do you wait for the tail or do you do the body? This is a personal choice because both are correct. What I do is I go over the body if there is a fairly decent difference. If there is almost no difference, then I will give it the tiny bit of extra and go over the tail. If the difference is insignificant, I'll include the tail. If it's not so insignificant, I want that extra price improvement with the body. I want you to imagine one of your stocks has this nice solid red bar, but you see this stock have no follow through so far and start to climb and climb and climb. You're watching this and climb. And as it approaches the high, you're like, whoa, if this takes out the high, this is a bull 180. You're seeing the potential bull 180 form right in front of your face. And boom, right there is your entry. Boom. Your protection needs to ideally be under both bars. And this protection, if you lose on it, you should not be losing more than your maximum loss per trade. Every trader needs to adhere to a maximum loss per trade. If your plan calls for a maximum loss per trade of 100, then you play one lot of 100 shares. The distance from your entry to your stop cannot be more than $1. If you do 2 shares and your maximum loss per trade is 100, then the distance from your entry to here can't be more than 50 cents. You have to play these things within the context of your maximum loss per trade. What if you really want this, but this would violate your maximum loss? Meaning, if you did 2 lots here, you would lose $120 and your maximum loss per trade is 100. This is what your plan calls for. So can you make this work? Yes. You can move your stop up to where you make it 100 as long as you are in the bottom portion of the bear 180. This is the bottom portion. This is the top portion. You need to be in the bottom portion, and preferably you should be in the bottom third. That's the best. You can adjust, but if you stay within the bottom third, you're still probably fine. Ideally, the stop should be under the entire event, but if you have to move it up, you can, as long as you're really close to the bottom. You do not want to be moving a stop up toward the middle or in the upper part. You're asking to be taken out of the play. Let's continue. This is a deep dive, guys. This is a deep dive to make you an expert on the bull 180. I've got a lot to cover here. Let's keep going. We know that your ideal entry is 1 penny above the high of the red. Because of the power of this event, you don't need to worry about how far in this 2-minute bar you are. This could be 20 seconds, 30 seconds. It doesn't matter. You are going to enter, no matter when this happens, right above the high. Stop above the low. If you can't get that low, stop somewhere in the bottom portion of the event, preferably under the whole thing. What if the bar that you're leapfrogging, the bear elephant bar, what if that's an elephant bar plus? Remember what an elephant bar plus is? It's actually more than an elephant. In this case, it is actually not wise to wait for this high to be broken. We need to get in earlier if the bar is taller than normal. And I want you to use 80% entry rule. If you get 80% of the way, it's probably okay. Let's say that's more or less 80. It's somewhat subjective, I know. It's the 80-20 rule. Boom, there's your entry when the red bar is tall. Same stop, or if you can't, at least be in that bottom portion. That is the anticipation entry for the Bull 180, but only when you have a red elephant bar plus. This is actually safer to enter here. Don't think that it's more aggressive. This is safer because your stop out is smaller than it would be here. So your anticipation entry, the 80% anticipation entry, is a safer entry in this case than the confirmation entry because your potential loss is smaller. Now, there's a tendency for many people to think that anticipation means more risky. Usually anticipation means less risky, believe it or not. There are some people who call these Bull 180s. This is more like what I would call a simple color change, but this is a Bull 180. We signify the bull as a plus. While some people do call the small color changes 180s, they're really not 180s in essence. What makes the 180 powerful is that something significant got overcome. Now, this is cool too in the right location, but this is far more significant because the bulls demonstrated their ability to neutralize something powerful. Here, you're neutralizing something small. It's not as impressive. It's okay in the right location, but it's not as impressive as a Bull 180 where the bulls have regained control from a very powerful force. That red elephant was proof that the bears were very powerful, but the bulls neutralized that power. They came back and overran the powerful bears by taking the entire bear bar out. Let's talk about what makes the Bull 180 very powerful, more powerful than it is, because it's powerful by itself. But let's talk about what adds to its power, what adds to its fuel, what adds fuel to its power. And so the first thing I would say, when this happens in a late stage down move, it is more powerful. So it is more powerful when your stock has been dropping, and you get the Bull 180 here. It's not early stage, it's late stage down move. So that's scenario number one. Also, if you have space, which means that your nearest moving average is far above. Your nearest moving average is a decent distance above you. So see, there's space. You're deep below the 20-period moving average. So if we combine both of these things, look at what we're combining. A solid move down. You're not early in the move down. Early in the move down is like one red bar before you, but this is multiple bar down move far. It leaves behind the 20, far below the 20. This is a very powerful location for the Bull 180. Let's go to the next location. Everything is in reverse as well, guys. When we're focused on the bull side of it, but you can flip everything I'm telling you to the bear side as well. What's another location? A flat 200. You get a bull 180 off of a flat 200 and you're golden. It's another very powerful location, okay? Some of you know the concept of a tight, fabulous four, a tight, narrow state. If you are getting a bull 180 off of a tight, narrow state. Remember the locations, far below the 20, a distance below the 20, on top of a flat 200, on top of a tight, narrow state. And we can also have, not as powerful as the rest, but still noteworthy, a 20-period moving average. So sometimes you can get these pullbacks that turn right off of a rising 20-period moving average. Have you seen that before? So what are the locations again? So below a 20, above a 200, a flat 200, then we'll put the 180 here. So 180, 180, 180, and don't forget 180, all right? You got those locations? Below, deep below your 20, right on top of a flat 200, right on top of a tight, narrow state, at or near a rising 20. We've got two scenarios. Let's do them again. We've got the regular elephant bar, bull 180, where you buy above the high. Boom. We have the elephant bar plus version, where your red elephant is actually a little extra tall there. And so here, you want to apply the 80% entry rule. We know that our stop should be under the lows. Well, if we can't, somewhere in that bottom portion of it, just to make sure the trade does not violate our maximum loss per trade. Now, you all need a maximum loss per trade, whatever that is. I don't like maximum loss per trade to less than $50. I think that 65, 70, up to 100 for a lot of traders works. The way you get your maximum loss in general is to first start off with what's your daily loss allowance, and then divide that by 2 or 3. If you want a smaller one, you divide your daily loss allowance by 3. If you want a slightly bigger one, you divide your daily loss allowance by 2. So in my program, most traders start off with a maximum daily loss allowance of 200, and some traders will divide this by 2 to get the $100, or by 3 to get a smaller one. You want to give yourself at least 2 to 3 chances per day. Now that we know the two different types, the confirmation bull 180 is on the left, where you're buying above the high. The anticipation bull 180, you're buying 80% up into the red elephant bar. We know that the most ideal stop is below both bars. If we can't, at least we need to be in the bottom portion. We know that time does not matter when it comes to this play. As soon as you cross the high, you're in. I don't care when that happens. As soon as you cross the 80% level in scenario number 2, doesn't matter. That's where you're making your entry. Let us go to some charts and take a look. I want to keep the detail on just basically how you identify this in the right locations, where you enter, and how you protect yourselves. Now, guys, remember, this is something that you don't have to search for. I don't want you searching. I want you watching. There's a difference between searching and watching. If Exxon is one of your stocks that you live with every day, you should not miss it. You'll see that the first 2-minute bar of the morning, or of the open in this case, is red. It is in a good location, but it's red. It's only a play if green takes it out. Okay, it is not a play. We don't play red from this position. That's a different topic, but we don't play red from position 1. Okay, we can only play to the upside. But now that I have a solid red bar, I need a bull 180 to play this. And if a bull 180 doesn't form, it's really not a play right now. You've got a tight little, nice little fat fork going on here. Look at the tightness of your moving average. That's the quick and dirty way. So you got a narrow state. You're right above the narrow state. Solid red bar. Can you do an 80%er here? I would say yes, Because look at the average size of your red bars over the recent history. That's how you judge it. So this is truly huge compared to your average red bars in the recent past. You don't have to go through all the past, just the recent past. And so I'm okay with you doing the 80% entry there. Boom, stop below the low. And the rest is history. Take a look here. Do you see the bear 180? Solid green, red takeout. It's a 2-bar event. Now, it doesn't have a lot of red before it, but it has strong red before it. Is it in a good location? Well, yes, it's in a perfect location, actually. Tight Fab 4, and you're playing it right there. To remember, 180 here is good. 180 here is good down. This is good up. Is this a bear 180 or is that a color change? That's a color change. Good. That's a play too, but that's not the focus today. Is this a bear 180 or color change? You tell me. Color change. Nice play, just not our focus today. But you should know the difference, yes. I want to do a 15-minute chart here. What kind of 180 is it, though? What kind of 180 am I pointing to now? Confirmation or anticipation, 80%. It's an 80%er, right? Bull 180 or color change? Yeah, I would say color change because the red is not really an elephant. You need to be a pure 180, your red should be an elephant. It's a color change because the red is not an elephant. That's an elephant bar. This is a normal red bar that doesn't qualify as an elephant. So if it doesn't qualify as an elephant, it could be just simply a color change. This is not an elephant bar. So that's a color change. So know the difference between elephants. Elephant, elephant. This is not an elephant. Not an elephant. An elephant on one item, one stock or one tradable item may not be an elephant on another. Elephants are relative to the actual item you're looking at. This might be an elephant on this stock, but if you were to flip to something else, that might be small. That might not qualify as an elephant. It's relative to its recent past, you see? And this is very sizable relative to the type of red bars it has recently been producing. All right, it's always relative to the actual play itself. You see this green bar with the tail, right? Do you see the high? At one point, wasn't that green bar tall all the way to the high? Now, what happened to the green? It started to fall, right? But every fall is really red. And then it just continued the next bar. Every fall is red. So this is one of your more advanced readings where that's your 80%. That's actually more than an elephant plus. There are different levels of elephants. There, you can go to what's called dual elephant, which is more than an elephant plus. And on the dual elephants, you can cut them in half. Elephant 1 and elephant 2. And your entry on a dual elephant is above the half point. That is when you have a really long red bar that is more than an elephant plus. It has moved into dual elephant territory and it's far away. And this one we cut in half as a play. Tawani's asking, what if your elephant bar, it takes several green to get it broken? This is also one of your plays. It's just not the one we're focused on today. That is actually in your deck. That is called a red bar takeout. So the way you look at this is immediate and this is delayed, but they're accomplishing the same thing and they're both powerful. On many occasions, the delayed sometimes can be a bit more powerful. But when it comes to the Bull 180, the immediate velocity and power of just punching red in the face so hard, I like the 180s better. Yeah, we got a 360 here. That's right. But this is very difficult because this bear 180 here is not happening in a good location, is it? Now, if you took that bear 180 up here far away, that would be different. But it's happening in the wrong location. If you put that bear 180 under, then that's good. But it's in the wrong location here. Remember the locations. On top of the 200, we're looking for the bull scenario. On the bottom, we're looking for the bear scenario. So guys, what I need you to do is practice identifying these. Practice finding them. Become an expert identifier. Line the ones up with the right location. See how they performed. Get used to them. Build your confidence in how reliable and how powerful some of the moves are that happen from them. It's important to see so many work and how they work that when it happens to you in real time, you lose the hesitation.
88% success rate. Write that down. 88% success rate. That's pretty damn near perfect. That means practically 9 times out of every 10 you will make money. Guys, that's crazy. Do this 10 times and only once you lose, maybe twice, but it's crazy. That is why, guys, when things are that high, you add them to your bread and butter bucket. Do you understand? I got a small handful of bread and butter plays that are so highly reliable that I play them heavily. And what I mean by bread and butter, they happen regularly enough to just be almost guaranteed money. The bread and butter or go-to play I want to talk about today is that crash into support. There are certain market environments where you can make your whole living doing just this. We are in that market environment. That's why I wanted to cover with you. We are in that market environment where you can make your whole living in the markets just doing the crash and go play. Now, it doesn't last forever, but it's prevalent now. This is one of the most valuable things you can have in your arsenal. It's like the clearing elephant bar off a flat 200 play. It falls into that category. The real bread and butter play is the one that crashes into an area of support. That support that it crashes into, it's coming from above support. So for instance, in this scenario I'm drawing now, it's crashing into the 200. It could do something like crash into a narrow state Fab 4. Boom, like that. There's your narrow state Fab 4. What we're looking for in this scenario is what I call the micro whale. Now, most of you should be familiar with the fact that we're looking for a 3-part move in almost every one of our trades. Part 1, the pullback is part 2, and the second part is the whale complete or secondary leg. But this is a micro whale where you crash into support, usually in one fell swoop. You bounce back up oftentimes, and then it crashes through the support. And that is a micro whale because that can happen inside of 2 minutes, and it can happen inside of just a couple of minutes. Whereas that your more macro whale will tend to happen over, a good portion of the opening period. Maybe it's over 15 minutes. Maybe it's over 20 minutes. Maybe it's over, 10 minutes, but it's not a few minutes. The micro whale is anywhere from 2 minutes to, maybe 6 minutes. Most of them are very micro in the sense that they are 4 minutes tops. 6 minutes tops. This play is a very short-term play. It can be played any time of day, but it's most prevalent right off of the open. I've explained this concept in the past as the wrecking ball concept, right? Because some traders are afraid to go into something right at major support. But Oliver, it's right at the 200. Yeah, I get it. But this was a wrecking ball that slammed into the side of the 200, weakening the 200 at its foundation. I don't know if you've ever seen that in the movies or on TV or even in person. When a building is being brought down by a big giant wrecking ball, the first swing sometimes does not break the whole building down. It crashes into the wall, it creates a hole, but it weakens the building at its foundation so that the next swing easily brings it
brings it down. So here's the weakening of the foundation, and a bounce is now the wrecking ball is swinging back, and the second one easily goes through and brings the building down. Okay, here, if you were to join this, you get this monster drop into the 200, right? Now, what's the odds of a bounce coming all the way back up like this is nothing? And the odds are very low, guys. Very low. Yeah, 1 in 10. It's very low. You know that pretty much any attempt for this to raise its head is going to be slapped back down. It's such a basic thing. When is the wall, when is the tower so tall, like it's like the Tower of Babylon, and you can pretty much see bounces aren't going to take this out. It's not going to happen. Here's a scenario. You guys see that? Now fill this in. This is when you don't eliminate the tail, because that's where it started from. Doesn't matter how late, the odds of green climbing all the way back up here is, like Ari says, 1 in 10. And the rest is history. This is crazy. They're so juicy. They produce gains so consistently that you can easily fall prey to just getting sloppy with it, meaning that any red that goes down to support, I'm going to short it. And so you stop requiring the collapse. You stop requiring the wrecking ball. You stop requiring the violence. You stop requiring the crash. And then you just start looking for any red on support, and you can start getting yourself into trouble. Be aware of that trap. The way I do this play when I see it is I'm trying to always get into the violent bar. I don't care how late I am. So I'm trying to get into this bar, but I'll get into, if it's late, I'll get into it lightly. So let's say I usually do 5 lots, I'm going to do 2 lots. But it doesn't matter how late, even if it's gotten all the way to support, I'm still going to get in. And the reason is because, but I'm going to get in small. And I'm going to get in small because the real play is the bounce and the color change right there. That's the real play. That's where I'm going to really hit it up, looking for the crash through of support. So my biggest win is going to come on the bounce. Now, why am I so confident going in heavy on that bounce? Is because this is a tall Babylon-like tower or wall. Almost no bounce is going to take out. So I'm as close to a guarantee as possible. You can't be guaranteed, but I'm as close to one as possible that I know the bounce is going to fail. I've got the highest probability. It's happening next to Babylon. I've got the highest probability that it's going to fail. So my ads on a bounce, unless the bounce is violent, we'll get into that. My ad on this bounce for you on the color change is typically heavy. Should it work, and it works most of the time, it's a huge score. Why is it that I'm always going to go into the crash bar, no matter how late it is? Because 50% don't bounce like I want them to. Why miss out on those? Do you follow what I'm saying, guys? Why not pick up 50% of the money? Get some of it. Don't let all of it disappear. Get some of it. I used to let all of it disappear and only get the bounces, but I was missing 50% of the money. So you're going to find over time that half don't bounce. Let me give you an example of this. What you'll find is the crash into the 200. Now, some people won't catch this, but I know many of you will because I've taught you this. You should always go back to where a fluid move to the downside began. The fluid move to the downside did not begin on bar 2. It began on bar 1. That was green. And from this tippy top, it started dropping and continued. So the way I'm going to look at this is I'm going to look at it together like one crash move that started there and dropped right into the 200. Boom! No matter how late. Now, we would want this to bounce to get that heavy load, right? But look. You didn't get it. Do you see what I'm saying? No bounce occurred. With PayPal, I want to look at the 5-minute and show you the same concept. Do you see the concept on this 5-minute chart? Do you see it? So you see it starts well above. It crashes into the 200, weakening it at its foundation. It bounces. The second bar bounces. And what's that sound? What's the sound of what happens next? Give me the sound. Somebody type it. There we go. Oh, it's quick. That's crazy, right? That's a good question. Let's talk about your stops. So I teach you, when you go into something, your stop should be above. What if that's too tall? Now what's your stop? If you can't do the event stop, what's your stop now? Not necessarily. Nope. There's only two stops, guys. There's no half stop or quarter stop, or where'd you get that from? What program are you in? There's only event or maximum. There's no 33% stop. Where did you get these things from, guys? Are you moonlighting on me and learning from someone else? Is that it? No. You've got two stops, event or max. Event or max. So if you go in here and you can't do this because it violates your maximum, you must go down, find at what point is it maximum? All right, that's my maximum loss per trade. All right. I can deal with that. Now, here's where I think some of you are getting mixed up with the third. As long as the maximum is not down here, you can do it. So if you can't get at the tippy top, what portion of the bar do you want your maximum to be? Top third. That's where the third is coming from. There we go. I mean, you guys are aristocrats here, huh? Look at these aristocrats. Aristocrats. Yeah, see? You got a bunch of aristocrats here. If we can't get our stop there, we find the maximum, and if it's in the top third, we can do the play. If you can't get it in the top third, then what you can do is skip the initial. Do you understand? And wait for the add. Does that make sense? Because you don't want to get knocked out on the bounce, guys. That's all I'm saying. Right.
I'm in short. Boom. I have orders through my ranges. As this continues to drop from my entry, now look at my entry. So I'm getting in around here, and we get almost $1. Almost. I got a profit take here, but not everything. I did not get everything because my profit takes are zones too. So I got the first layer of profit taking because it did not get low enough to get to the second layer. That's important to understand. Stop for me. Well, first of all, you would not want this to be breaking the new high. So if you wanted a technical stop, your stop is technical. I usually on these plays use a maximum loss per trade. So I take partial profits and I am now willing to let this bounce on me, right? At this particular point, I'm like, I'm either going to get more profits or I'm going to get a bounce. We bounce from here. Now I'm going to draw the green because some of the green is hiding from you. Look at this bounce. And this bounce from the low, there's a green bar hiding from you there, right? That gets one or two, I think it got maybe one or two of my sell orders. You understand? It got one or two of my sell orders and then fell right away. Boom, watch this. Boom. And it fell. Read between the lines here, guys. Read between the lines. It fell all the way to here, the low. See the low? Now there's a red bar hiding from you there. I get in again, and boom, I take more profits. Now, my profit here on this part is really quite sizable now because remember, I initially get in here, I only take partial profits there. Then I get two more additional lots in addition to the original one. So I'm now heavier than ever. I'm heavier than ever now. Okay?
And then this drop explodes my profitability. And so I get out of almost the whole trade here. I get out of everything except a couple hundred shares, which I don't worry about. Okay? So I close the trade here. Now, why do I do that? Because for me, my first goal, guys, is a micro whale. Micro whales take care of my life, guys. So look, drop, boom, that's profit. Boom, more, that's profit. Boom. I have a very interesting topic I'd like to cover with you today. It is going to be something that I think adds some tremendous value to your ability to pick accurate turning points in the market. And I think this topic is going to be really apropos, meaning that it's going to be very well timed for what we're going through in current markets today. The ability to determine after an extended move in one direction or another when the market or an individual item is likely, has higher odds of turning, is one of the crowning jewels of masterful market play. Now, everything is not the crowning jewel of master market play or masterful market play, but there are certain things that really form the cornerstone of just the highest level of trading. And your ability to find moments that present a higher probability than others that a turn in the market is not a fake out, but is a real turn, is one of those crowning jewels, is one of those cornerstones of masterful marketplace. So I'm going to cover a concept today, the time and space concept. We're going to cover this concept to help you improve your ability to pick major turning points in the market. Please like this presentation. Your comments are always welcome. If you have not subscribed to the channel, please do click the bell in the upper right hand corner, turn all notifications on, because this is a place where you do not want to miss one single piece of content. We spend a great deal of time every single day making sure that something gets out to you that takes you one step closer to that ultimate goal of sophisticated and professional market play. If you start from a point like this, there is no time and space at this point, right? They both don't exist. However, if I move one step to the right, I create space between point 1 and point 2. But it has also required time. So the very creation of space has also simultaneously created time. And to a certain extent, that means time and space really don't have difference whatsoever. Now, let me go a little bit deeper into this concept before we go to charts, all right? In the market, what exactly equates to space? Well, we have two axes, I think that's the word, in the market, right? There is the price axis, and it runs the gamut up and down. That axis is what I consider to be space. Up and down is space. Time is the horizontal axis, okay? So we have the time axis here, and we have the space axis here. When you create space, you're also creating time. So if I go to 20 from here, I have created time and space at the same time. I've created time by going to the 2, and I've created space by going to the 20. It has taken me time to get to the 20, which equals the 2, the integer 2. All right. Same thing here would be, in order to get to create more space, I'm also creating time. It is possible for something to create space faster than it's creating time. What I've demonstrated here is I've demonstrated the scenario where time, to create space, I've also created the equal amount of time. So my time axis is equal to my space axis. Time and space are equal. This is the equal form. It is possible to create space faster than you're creating time.
and vice versa. It is possible to create time, more time than you're creating space. So they're not always equal. And I'm going to go to charts to show you this. But here's the main point before we go to charts. It is when they are equal that we find the most powerful turning points in a stock. It is when a stock has produced price, space, and time to produce that space in equal proportion, more or less, that a turn is more likely. It is when they are not equal that an attempt to turn is usually false. So let me demonstrate this really fast for you, okay? A stock opens for the day here. Let's say we're assuming a 2-minute time frame chart, all right? It drops from the opening price, it just drops really fast. That means it's creating space. Let's say it started at 40. Down here, it's at 38. It created space. Remember, time is space. It created space faster than it created time. So if I take the space axis, which is here, 40 to 38, that axis is taller than my time axis. So my time axis, if I were to put these side by side, there would be one axis that's really short compared to another axis. So my space is longer than my time, which means that if my stock attempts to bounce from here, it will likely be a failed bounce because it's bouncing from a non-equal state regarding space and time. So this attempt to move up is a failed attempt most of the time, not all the time. Nothing can be all the time in life, okay? Most of the time. This rally from a drop that has the space long but the time short will usually create a failed scenario. Now let's take the same space drop from 40 to 38. We're going to create the same space. And yet, what we're going to do, though, is that space is going to be accomplished with time. And so now we've got the same drop in space, but the time is starting to become equal to the space. And so any attempt here to move up is more likely to be real because my time axis and my space, they don't have to be perfectly equal, but they're more equal. If you only freaking knew how powerful this is. There are so many traders that get trapped into these fake moves to the upside, not knowing which moves to the upside have a higher propensity to fail versus those that should be looked at. That's a real freaking move to the upside. And it all depends on time and space, this concept that I'm covering with you. When those two axes, space and time, are relatively equal, I don't want you to start being freaking anal about everything where you have a ruler. Oliver, let me measure this. This is like 2 centimeters off. It's not quite as equal. No, we're not that specific. It's just generally there's no wide, dilapidated difference, you understand? Where one looks so little and the other looks so big, that's not going to work. And that's where you get the fake moves that capture or trap a lot of traders that do not understand this concept. All right, so let's go back to it again. So remember, this kind of drop, the beginning, end, did not, the space and the time are too off. So now, boom, that move up is is going to be fake most of the time. Versus this move up is likely to be more real. Boom. Now, let's take this version of space and time being relatively close to the same size. Okay? Let's take a scenario where the drop is sharp. So here's the drop is sharp, and here the drop is more gradual, right? Well, there's a way to get space and time equal with a sharp drop as well. Let's go over that. So you can have this scenario where you drop hard, you have this fake out rally, boom, fails, but this next move down gets you the time. So here's your time axis, here's your space axis, and your time axis. But this move up was the fake one you don't believe because the time was too short. But this one is the one you trust because time has grown to be relatively equal to the space. And so you can get this time by a more gradual move down or a sharp move that bounces around long enough to give you the time necessary, to grow the time necessary to be relatively equal to space. I need you to tell me if you understand the theory, you understand the thesis, you understand the foundational block. You understand this so far? Good? Sound good? Do you get it? Are you picking up what I'm laying down? We're going to go to charts now. I want you to understand that this drop created time and space. And as you can see from here to there, time and space are relatively equal. Relatively equal. And there was a play to be had here. Boom. And there's your two-part play. I'm always going after that. 1, 2, 3. 1, 2, 3. 1, 2, 3. 1, 2, 3. If I'm playing to the downside, traders, I'm looking for this. 1, 2, 3. Look. 1, 2, 3. All right. On the upside, we're looking for 1, 2, 3. You understand? From the upside, 1, 2, 3. From the downside, 1, 2, 3. If you're not going for that, then you don't know what you're doing. Space. This is your space part. And then here's your time. So look at the attempt here is not the 1. The attempt here is not the 1. The attempt here, your time and your space are relatively even. So you can get something a little more thorough from here. All right. So trying a color change, boom. Red takes out this, green takes out this red bar. I'm going to try this color change down here because I have enough time. In addition to that, another concept of space is that my stock has space between the stock. There's space between the stock and the 20, and there's space between the 20 and the 200 period moving average. We call that dual space. And when I've got dual space up and down with time and space being equal, more or less, I've got all three things in my favor. I've got space, I've got time, and I've got the dual space concept between stock, like the 3-finger spread, stock 20 and 200 wide apart, all coming together at the same time, producing a perfect little box. Boom, the odds of a turn from that perfect box is higher than normal. Is it perfect? No, nothing's perfect. Is it 100%? No, nothing's 100%. The majority of time, yes. Higher probability, yes. Now, there's something else here. This play was a really powerful play because the spaces, the times were equal. So if we go here and we do this time, and then we do this time. Well, this time is a little bit longer, I have to admit. But that turn, we had a move up, all right? This turn here is wide enough from this turn for me to have enough time to go again. Now that's a different tactic. What I mean is that, guys, look, a bottom here and a bottom real fast doesn't usually work. You see the two closed bottoms? When the bottoms are separated by time enough, they have greater odds. So my bottom here and my bottom there are separated by enough time, there's that concept again, to go. Now, what's cool is that I also have the space. The 20 is still far. The 20 is still far from, the 200 is still far from my. If this were to happen here, it's a different story. But this whole amount of space is like open air for the stock to flow to the upside. So if I'm taking this green bar play here because of this time and space between the two lows and this space to move back up to the next resistance, the 200 is my next resistance, I've got space to move back there. And I've had time enough between the two lows to make this attempt real. You see how there's so many ways to look at or to incorporate time and space into your trading analysis. I teach traders that when a stock produces too much space between its closest key moving average, it's time for a rest. So here's the stock moving, creating space between the stock and the 20, and we come back, creating space between the stock and the 20, and we come back, and then creating space this way, backwards, between the stock and the 20, and we come back. Now creating space again between the stock and the 20, and we come back. The market doesn't like to produce wide space without narrowing it again. Take a look. We have no space between the 20 and the stock. We produce space away from it, and then we move back to it, only to move away to create space again from it. And you either move to it or move through it, and maybe you start producing space on the other side. There's a lot of space concepts that I teach my traders. But the one I'm focused on more today is when time and space do become equal. Let's take a look at this. Here you have a move to the downside. So we create the space this way. But here, the time, if I count it from here to there, the space is a bit longer than the time. Now, this move from here was still fairly decent, but the one that really counted for me was this one. That turn and that 20 MA catch right there was my key. My traders know I love the 20 MA catch, which is you come from under the 20 period moving average, you get above, and then the 20 catches it. And I'm like, okay, now we're off to the races. If my 20 MA catches it, you see how kind of like this didn't really catch it? It kind of broke through. It still worked in a way, but this one, because of the full outright time being mature enough, this 20 MA catch was the real one. That was the big play. Now, guys, there's one way to think about this. It's that time heals all wounds, right? If you were to have a bad experience in your life, a bad breakup, a bad relationship, a painful one, it's painful in the beginning. You break up, or a bad scenario, or a bad incident, that memory is sharp, it's painful in the beginning. But over time, you are moving yourself further and further away from a time perspective, away from the event, the painful event that occurred, an accident or a broken relationship. And the more time you place between that incident and where you are from a time perspective, the less sting that the pain has, it's not as acute. And the more time, the more separation. So if we were to demonstrate this, here's the pain. And if you try to rebound too quickly, you haven't enough time to be healed from that pain yet. And this will likely fail. But if you were to drift this way, away from the original pain, the further you get away from that pain, the more you put that painful incident in distant memory, and the less painful it is. And now your attempt to rebound is free from the painful event. Let me go back to this and draw this for you. So here is the painful event. Boom. And if you try to rebound too quickly here, you haven't experienced enough time to heal from that pain. The stock hasn't healed from that pain. So this drop is likely to fail. The pain is still relevant. But if you were to drift away from that pain, now the pain is way over here. You've had time to distance, the stock has had time to distance itself from that painful occurrence, that sharp, violent drop. It has mended itself through time, and now this attempt can be considered more real. It is unfettered by the initial pain that the stock experienced or the item experienced. So here's your initial pain. This attempt is likely to fail. But with enough time, now the attempt here has more likelihood of being real because of the separation of where the pain started from. Here's the start of your pain. And the pain is likely less acute here. So there's this level of acuteness that gets less and less along the way here. Further away from pain, the attempt to move up, the greater the odds that the move up is real and not a fake out. Do you understand? So it's this bottom that turned out to be the real one. That's the one that took it all the way back to eliminate the pain. It went past the pain. It wasn't this one that went past it because it attempted too close to the origin of the pain. This is too close. I'll do that. I know I'm drawing sloppily here, but this is too close to the origin of the pain. It's not enough healing yet. But here, yes. Another thing you have to look at is that we've got time here. This attempt to move up from here, this attempt is happening with time from the origin, right? So we got time, but we also have space. Now look at the space between your 200 and your 20. So if I were to eliminate the prices here, you would see like a nice little cup, right? So imagine the prices aren't here. You'd see the 20 separate itself from the 200, get nice and wide, and start to cup up, right? And then come right back. Well, your best turning points are after this gets wide. You understand? So that's wide. And that turning point having time and space, remember, it's not always equal, but as long as, guys, I would rather my timeline longer than my space line, then my space line longer than my timeline. So if this time is a little bit longer than space, but that's not a bad thing. Because remember, time heals all wounds. The more time you have, the more healing. So if I'm going to err on one of them not being equal, I'd rather time be the longer one than space be the longer one. All right. And so remember, I told you my traders love a 20 MA halt. Here's a 20 MA halt. Here's another 20 MA halt. And boom, we're off to the races. And notice the concept of space, even just on micro moves. We get spacey from here to there. It's time to come back in. We get spacey from here to there. It's time to come back in. We get spacey from here to there. It's time to move back up. So this concept of space and time is so valuable in a variety of ways for timing turns in the market. I want you to look at Tesla's turn here. I want you to look at Tesla's gap to the downside. All right. Now look at the time from the opening bar here. Look at the time. Now look at the space from yesterday's close. So here, this attempt, the time is too short, right, for the space. All right, give me a second here. They can go by, it's fine. The time is too short, guys, for the space. Do you follow what I'm saying? And so our time, this move up is likely not to be real. You see? Boom. But the more time, the better. Now, notice the length of time now. It's longer than space. But remember, if you're going to have one longer, it's better to have the time line longer than space than the other way around. And so now your attempts now, look at the 20 MA catch. That's huge. That's huge. Do you understand how valuable this is? You know how many people are thrown and knocked out of these false moves to the upside, even this one. Imagine someone thinking that the move up from here is high odds when the space, the space and time is nothing. All right, that move is likely to fail. This one's better, but it's still not enough until you get over here. Now we can start trusting. In addition, look at the space. Remember, the 200 leaves, the 20 leaves the 200 and then cups. Look at the space between your moving averages now. So we've got space, we've got time, adequate time. Now we can trust the attempts to turn. The attempts to turn now are going to be robust. The attempts to turn now will have high odds of follow through. The attempts to turn from this wide space with adequate healing time can produce some massive, massive turns to the upside. You know, say, oh, wow, this is really great, Oliver. Ha, this is really awesome. You have to like the video, like. Oh, that was really cool, Oliver. And then you go about your normal everyday life and you say, yeah, that's great, Oliver. Let me like the video. Like, that's not how you make this work, right? You can't trade my knowledge or my experience. I can share my knowledge and experience with you, but that means that you have conceptual or intellectual knowledge. In order to move knowledge that first starts intellectually here, in order to move it from the intellect to the heart, requires time and experience. So you have to now, from this point, go into the real world. You have to look for time and space. You have to search for it. When you see it, capture an image for it. Drop it into a folder on your desktop. Collect the images that represent time and space. Get used to identifying them. Try a time and space concept every now and then. Play it small. Track whether it stopped out, track whether it gained for you. All right. Study charts and look for time and space in the past. This is working with it. This is grappling with it. This is falling with it, being successful with it, failing with it. All of it matters. You then are moving the concept from being intellectual, you can't, to the heart, being experiential. You can't make money from intellectual knowledge. The same way you can't read a book on becoming a great doctor, and now you're a doctor because you read a book. The same way in trading. You can't become good just because you went to a seminar or you sat through an Oliver Velez class or you watched an Oliver Velez video or even you read an Oliver Velez book. You can't do it that way. I'm not saying those things are not important. Those are the starting places. You must start with intellectual know-how. You must start with intellectual or conceptual knowledge, but it must be moved away from the intellect, and into the heart, which is the symbol of experience, right? You move it from the mind to the heart. You move it from a concept to real life know-how through experience. And the last thing I will remind you of is that your success in this game and in any other game in life, your success is always on the other side of your experience. You cannot be successful before your experience. That's called luck. We're not after luck. We're not after getting it right just because of math, just because I flipped the coin long enough. I'm not interested in luck. I don't want you to be interested in luck. I'm not interested in chance. I don't want you to be interested in chance. I want what you produce to come from you. I don't even want it to come from me. And in order for it to come from you, you have to move it from being Oliver's concept to now the concept is freaking mine because I've worked with it long enough and thoroughly enough to have gained enough experience with the concept that I can put my own freaking name on it now. And that is the point where it will start to pay you. That is the point at which you deserve to get real, lasting results. This takes work, ladies and gentlemen.